trading at its best.
Okay, welcome everybody to today's Forex Weekly webinar. This one is being held on Monday. We usually do them on Fridays, and this Friday we'll resume back on schedule. And so I want to thank everybody for coming. Today we have a lot of good things for you that are, if you apply them, will make a huge difference in your trading. And once again, I'm Mike Swanson, and we've had 101 webinars with Nate about a month or so, a few weeks ago, and hopefully you guys enjoyed those. These webinars are more for you get to provide us with things you'd like to learn more about, or we come up with things that we think are really important for you to understand, and we hold a webinar about it, such as the previous ones were about robots. A lot of questions are coming in about some different robots that were out there, so we held some webinars. Okay, so today is going to be about the top 3 trading mistakes. The first mistake that traders make is searching for the Holy Grail. Now the problem with looking for these types of systems is that you can find them. You'll find those Holy Grails. However, they're not really much of a Holy Grail when they only last a few months. And that's what you guys are probably used to seeing, is you bought a system, you tried out a system, it's doing extremely well while you've been watching it. As soon as you start trading it, or when you've been trading it for a little while, it falls apart and you lose all your profits or a lot of your account. Now the key to long-term success is you don't have to find that perfect system. And you know, a lot of times you can get away with just finding a small edge in your trading. It doesn't have to be much. It might be as simple as just making sure you always take trades in the direction of the trend, the 200 EMA. That one, you know, I know that one can make it a little small change or a little effect on your trading. Now you're probably thinking that's not all you need to do. There's much more to it than that, and that's true. That's why I'm going to show you a couple other things here, a couple of these mistakes, and when you put it all together, you're going to see how your problem is not just your strategy. Okay, now we've got a strategy called Momentix. Some of you might have tried it out. That basically has everything built into it. You know, the entry, the stops, the targets, everything. And even then, I got plenty of traders that aren't successful because they are still making these other 2 mistakes that we're going to talk about. But what you have to learn is that the key is you don't need the best system, and you have to convince yourself of this. You can't be looking for a system that's going to, basically, we can draw a little curve and show you what I'm talking about here, is you basically don't have to have a system that looks very linear with these small little bumps, because those are the types of systems that are like I say, these holy grails that do this, and you're always stuck right here. Maybe you start trading the system right there and then it flops on you. If you try to find a system that has that real short-term consistency where day by day you're making money, week by week, month by month, just killing it, it's going to turn around and kill you on the way down when it falls out of sync with the market, or just goes through one of those drawdowns. And maybe it's not always that bad, but most of the systems work this way if they're claiming these huge returns or what appear to be these holy grail systems. Okay, what you're really looking for is something like this. And this might not look all that great. Okay, that is actually a much better system, because you've got normal losses and drawdown periods here, you've got winning periods, and overall you've made good money. Maybe it's not 100% a month or these huge returns that these other systems claim, but this is what's going to last. And if you look for these types of systems and stick with them, if you're going through these drawdown periods, don't think that, okay, I gave back all that profit, oh no, what am I going to do? You know, you're looking at over here, you know, as you started growing, you gave it all back, and you're like, wow, 2 or 3 months and I gave it all back. And that's when you guys are giving up on these systems. And that's because you want that short term. You're looking for those short term drawdowns, and that stuff, like I say, just doesn't exist long term. It might work for a few months, maybe it works for a year. But if you want something that works year after year after year, this is what you need to be looking at. And one thing you can do is look at it this way. Some of you might have been trading for a few years. You've probably spent thousands of dollars on software programs. You've probably funded several accounts. Think of what would it be like if you had a system that was just making a consistent smaller return. Maybe it was only making you a few % a month. If you compound that over those years, you'd be in a much better situation, right? So you've always got to keep that in mind, that the long term is so much more important. This is something that's very difficult to do. If you think about it, most people get to approaching the age of 65 for retirement, and they're in a lot of trouble, and they don't realize it until it's too late. And they're then trying to hurry and save and figure it out. It's because they don't really care about it. When it's 10 or 20 years before, it's the money they're spending on things and that they're not saving wasn't a big deal, because people naturally think of what's important now, not what's important 5, 10, 15 years from now. And the same thing happens when they go and try to trade. They think, what can I do to make me X amount of dollars by the end of this month or end of this 6 months, or I want to make $1 million this year. And that's just not going to work. There's very few people that get lucky that have that kind of success, and you don't want to spend your whole trading career trying to become that lucky person. It's much better to learn some of the things I'm going to show you today so you can put yourself in a better position for the long term. And sometimes you might even see some success in the short term, and that's great too, but don't really you don't have to plan everything around that. Okay, so the key here is long-term consistency is much better than any holy grail system where there's just this gambling chance of making a lot of money. So let's move on to the next thing. Emotions and revenge trading. Okay, this is something that I'm sure most of you have experienced, and if you haven't, you gotta be very careful because it's extremely dangerous situation. You can wipe out your entire account and run into all kinds of problems because of this situation that can just take over almost. And basically what happens is it goes something like this. You have all of your indicators lined up. You know that if everything lines up just right, you have a very high chance of winning on your trade. You should almost never lose. And so you set up, you get into a trade. Now you have your stop loss in place, everything's good to go, you're really confident in the trade. Well then, some time goes by and the stop loss gets hit. And now you're thinking, how did that happen? Why did the market go against me? And so you're really confused, and you say, okay, well, my system's still saying it's good to trade, get back in the trade, so you jump back in. You take another trade. Some more time passes. Now you're like, oh no, I can't believe the market's turning on me still. It's still going against me. Now it hits your stop loss again. And maybe what you even do is you move your stop loss, which is a very dangerous situation. You move your stop loss. Now panic is kicked in, and you have another huge loss with with your trade, and you look at it as, okay, I'm done with this pair, I'm done with this time frame. You try to find another chart that looks better, and then you think, okay, I'll go get those losses back. And you start taking trade after trade after trade, losing more and more money. And one of the worst things that can happen is you do get it back. Sounds kind of strange, but it's not a good thing to succeed in that situation. The reason why is because the next time it happens, you're going to remember that the last time it happened, it worked. So you'll do the same thing again, and one of these times it'll catch you, and you'll wipe out your account. Okay, so that's revenge trading. It's basically when you deviate from your plan, or you look at it as, I've got to get these losses back, and you start making reckless trades and trading decisions. So it might look something like this. You're basically, everything's kind of cruising along, everything's great, you're making all this money on your trades, and then you start having a loss, and you're like, well, what's that? That's not normal, something's not right. And you want to get it back and get back on track. and you lose again. And once again, like I showed you, you don't know why that happened. So on the next one, maybe this one, it kind of popped back up, and your stop would not have been hit if you gave it more room. So that's the next trade, you leave it more room, and this time it really gets nailed. Now you've given everything back, and it's going to be really difficult to get back on track. So that's what's happening to most traders when they get into this revenge trading mode. Now, this problem usually comes from two things. There's two things that usually cause this. First thing is trading with money you cannot afford to lose, and the second thing would be trading for income. When you're basically looking at it as you want to make a certain amount of money per day or per month. That's when this revenge trading is most likely to kick in. And so let's start with the first thing. If you're trading with money you can't afford to lose, what happens is when you lose a good chunk of money like you do here, you don't like that loss. You look at that as, it should not have happened, and you want to get it back. And when you want to get it back, you are even more careful that you don't want to lose more money, so you want to make sure that one wins. And when that one doesn't win, things just, domino effect happens and you lose a lot of money. So you've got to watch out for this one. And like I said, the next thing is traders that are thinking, okay, I want to make $1,000 a month, or I want to cover my bills, I need to make a certain dollar amount per month, and they set these goals. They set these goals of, okay, to do that, I've seen people set things like 5 pips a day, 10 pips a day. There's these different systems all over the forums about setting these pip goals. Now, those are fine, except the mistake most traders make is they think, okay, I've got to make that many pips every single day. So, they get in there and they make 5 pips, they make 5 pips, and the next day they're struggling to even make 5 pips. Maybe their first trade starts off something like this. Let's bring this over here. Okay, so the first trade, basically you start off with a losing trade. So if you start off at minus, maybe you lose 25 pips in the first trade. Well, now the rest of the day all you can think about is you got to make 5 pips. And so your next trade, maybe you win, you get 15. Now you're down 10, you get another 5. You're getting close. Maybe you pick up another 15. Okay. So now you might have made it back, but let's say one of these didn't happen. There might be a situation where you kept going and you lost again here. You lost 20. Now you just keep going down and you're thinking, I got to get that 5 pips, and you keep trading. You just keep losing. This will happen. Maybe you just go so deep that you finally have to quit. And now you're down. We could add this up. We'll see where you're at. 75 pips down. So now you're down 75 pips. Well, if you're only looking for 5 pips a day and you're quitting those days at 5 pips, if you have this situation, which is very likely, now you're way behind. And this is going to cause you to want to go do that revenge trading because you have to get that back. And it can cause you a lot of trouble. So like I say, don't set these goals in stone that you have to make 5 or 10 pips a day to achieve a certain income or money amount that you're looking for each week, or don't set those type of goals. If you want to set a goal of like 5 pips a day, make it an average. Say I want to average 5 pips a day, and don't make it that you have to do that. Just set that as a gauge and a way of kind of throttling your trading. So let me give you an example here. I should probably just leave all those. Okay, so let's say you had a trading go like that, and you had maybe a 25 and a 15. We could go through and print out a bunch of these numbers, but let's say it comes out. I'm just going to say, let's delete these. Let's say you've had a month go by, so like 30 days of trading. So 30 days goes by, and you're up 150 pips. Well, there you go. You made your 5 pips per day. Okay, that's how you should set that goal. And something with that kind of a goal, your trading pip curve might look something like this. Okay, so here you are, you made 150 pips, and you had plenty of bad days, bad weeks where you just weren't winning or going flat. And that's normal. And that's the way you will reach these types of goals. Not trying to do 5 pips a day where it looks like this. That just is not going to happen. because you're going to have these equity drawdowns in here where you can't get it back, and you'll have to quit that day way down here, and that's going to cause you all kinds of trouble. Okay, so that's, like I say, if you set these goals, don't set them in stone, or set them out more long term. Push them out. 30-day goal, maybe a 6-month, maybe at the end of the year you just say, I want to look back at the previous year and look at it as I average 5 pips a day on my trading. Okay. So now let me show you something you can do to help with this, to prevent this revenge and emotional trading. What you can do is set stopping points when you trade. And what I mean by that is just very simple, like a strikeout rule. What I'll do when I trade is, if I take a trade and lose, I will take another trade. If I lose again, I will go back and look at these 2 trades, see what I did wrong, make some adjustments, some improvements, and be very conservative on this 3rd trade. I will try to make sure I've looked at everything, I've timed it, and that way I have the greatest chance of succeeding on this trade. And most of the time I will. But you have to always keep in mind, it can strike out and lose. And so let's say you do lose on this trade. I will then quit for the day. If I'm a day trader, I'm quitting for the day. If I'm a swing trader, I'm quitting for the week. If I'm a position trader, I'm quitting for the month. So I will quit and look at it as, if I come back the next day, I can probably make this all back and it's not a big deal. I'll just get back on track. If you continue to strike out and lose more and more, this is what will happen too. This makes it so now you've just ruined your week. It's going to be just revenge trading is going to happen, because you're going to be fighting to get back all these losses. So don't let that happen. Set this little strikeout rule. Make it so that on your strike 2, you're really focused. Just like a baseball game. The guy's really focused. He's just does not want to miss that next shot. And that's what you need to do. Do your best to not miss. But as in baseball, plenty of strikeouts happen, and you have to be prepared for that and know when to quit. Okay, now the next thing you can do is, there's going to be times when you are on the other side making money, and you need to know when to quit when you're winning, because your emotions can kick in and tell you, oh, there's no way you're going to lose. You're kicking butt. Don't quit. And that's when something like this happens. Oops. I'm just going to draw an example trader equity curve when they're going through that winning phase. Okay, things are heading straight up, and now you're thinking, wow, I've made all these winning trades. And as soon as you lose one, now you look at it as, oh, that was just a little blip, I'm going to trade some more, and you lose. And again, you convince yourself that that was just part of the, something was wrong and you made a mistake, maybe you fixed it and you won, and okay, I'm good now. Well, and you continue to trade and you lose. Now you've given back everything for that day or for that month. And a lot of times traders will continue and they'll get into all kinds of trouble. So let me show you what you can do on the winning side. We'll treat it very similar to what we do on the losing side, losing phases. Let's say we're heading up and we're having a great day or a great week, great month. We can set these same type of stopping points. Let's say that I'm risking 2 or 3% on some of these trades, or 1% on those losing trades, which would mean if I hit 3 of them at 1%, I'll lose 3%. So depending on what my risk to reward ratio is, if it's about 1 to 1, I will equally look for that much in profit before I quit. So I'll look for 3%. I might go a little bit more. Maybe I go 4 or 5 or 6, but just keep it right around there. So here maybe I've made 1%, 2%, 3%. I'm up here at 4%, which is where I'd want to quit, because this might be what's going to happen if I continue trading. I might give it all back. So that's not always going to be the way it happens. Many times traders will quit here and then continue to watch the charts and pretend like they were in trades, and they see this and they're thinking, man, why did I quit? Don't do that. The best thing to do is, when you quit, turn off your charts. You're done. There's no need for them to be up. When you quit trading, you must leave for the day, or if it's the week, if you're swing, you've got to walk away and not do that, because it's very difficult to not be to keep that temptation up and not pull the trigger on another trade, even if it looks perfect. you don't want to do this, because over the long term you're going to see all kinds of opportunities like this for revenge trading when you start to give it back. And a lot of times this has a lot to do with your strategy of making, you're kind of building a strategy doing things like this, because a lot of strategies have this same failure where they have winning phases and then they give it all back, and you can stop that. Just make a little simple change like this and you can put a stop to that and improve the strategy itself that way. Okay, now those are just a few things I highly suggest you try out in your trading. Let's see, let's move on to the second part we've kind of talked about a little bit, is funding a small account hoping to earn a large return to provide income. That's very dangerous and will result in this revenge trading, because what you usually are doing is you're putting a little small account together hoping to double it or triple it at the end of the month and take the profits out and then do it over and over and over. And maybe it's not even a small account. There's other traders with big accounts that are trying to make a certain income every month. What they don't realize is there's going to be losing months. And if there's losing months, you're not going to have income to pull. There's different ways you could set that up. I've seen traders that even, what they'll do is they can determine how much money they want to be able to pull out of their trading account every month. And then what they'll do is, regardless, every month they will pull that money out. And it takes a little bit of setting up to figure out how much you can do and how much you need to have in your account based on your goals and your trading. But that's the best way to do it, is don't look at it as, in order to pull money out I have to make X amount, because that's something you really don't have a lot of control over. You don't have control over drawdowns. They will happen unexpectedly. When you think you're having your best day, you'll have your worst trading day. All that kind of stuff can happen. You just have to be prepared for it, and you'll be far better off. So I think that's everything we want to talk about for emotions and revenge trading. So let's move on to the third thing here. Poor money management. Okay, money management is defined kind of differently by each trader or different people out there, but what we're really going to talk about is trading at the correct lot size to prevent margin calls and to properly be set up for risk management. And this is probably the most important part of your trading, because it determines the outcome of your trade. For example, if you trade a micro lot and you make 200 pips on a trade, on a day trade, it was like a great, amazing trade, that's not really very much money, because a micro lot's only going to be 10 cents a pip. But if you're trading the standard lot on that trade, that's $10 a pip. Now that's a $2,000 trade instead of a $20 trade. That's just such a huge difference that you can't afford to miss this part of your trading. This, like I say, is sometimes more important than the strategy of opening and closing the trade itself. Because if you miss this part, either you're going to lose a ton of money, or you're not going to be making much for the risk that you're taking on these trades. So let me give you an example of how we would calculate this. And I'm going to tell you that we have a tool called PipStat that takes out all this calculation and work, but I want you guys to kind of see it. So those of you that are not using PipStat can understand how to do this. Okay, so let's say what you need to do is you take $1,000. Let's say you figure out your trading balance that you're going to risk, and that's step one. Figure out a trading amount that you can invest that will not affect your life and that you don't have to worry about it. Don't put money in that you're going to be so worried about losing it that you can't even focus on your trades. If you find yourself having to keep flipping your account up, pulling it up, and looking at the balance, looking at if you have to keep your eyes on that, keep your eyes glued to it so much, then you've got too much money in the market. So let's just say you decide, okay, that's $1,000. Next step is to figure out how much of that should you be risking per trade. And a lot of you have probably heard the whole risk 2 or 3% per trade. I'm going to tell you that it might be way too much for you. That's probably could be extremely too much, or maybe not enough. It all depends on really your style of trading, as far as if you're taking just a few trades a day, a few trades a week, a month, if you're swing trading. All those variables help determine this. Obviously, if you're a position trader where you're maybe taking a few trades a month, risking 2% is not really going to probably be very valuable, because if you risk 2%, let's say you had 4 trades. Let's say your first one you made 2%, your second one you lost, your third one you made 3, and your fourth one you made 1. You've only made a few percent, and you've probably had some great trades. So in that case, you might want to risk more. If you're a day trader, you might find that risking 2% and you're taking 3 to 5 trades a day could put you in a really bad situation when you have a bad week. Okay, so in order to figure that percentage out, the first thing we want to do here, figure out our overall drawdown that we can afford to have on our account. And I'll tell you, based on statistics, 25% is the max you want to use, absolute max. And maybe 25 is way too much. Let's say you have 100 grand. You probably are thinking, oh wow, I don't want to risk 25 grand. That's way too much. And you can scale that down, definitely. All I'm saying is that's the maximum you would want to use. And the reason why is, let me just give you a little drawing. Hopefully this isn't too confusing. Is basically, if we were to look at this side over here, I'm going to draw a graph. This side we're going to say represents the drawdown needed to recover. Okay, I'll just see if I can write the word recover with my mouse. Hopefully you can read that, recover, and then this is actual drawdown that you had over here. So I'm not the best at drawing with my mouse, but anyways, you get the idea. So this is going to be in percentages. So this is 0 to 100%, and this side will be 0. This could be like 1,000%. This can go way up, because what it takes to recover from an actual drawdown. I'll show you how that works. And it's going to look something like this. Okay. Now with that drawing, let me explain what this means. 25% might be about right here, and that means it's going to take a 33% return to get back a 25% loss. Okay, and let me tell you how I do that, how I calculated that. If I have $1,000 and I lose 25%, that means I've lost $250. I now only have $750 left. In order to get back to $1,000, I've got to make $250 on that account, on that new account size. So all I have to do is take 250 divided by 750. Terrible drawing with this, but and you can see that that's 33.3% if you did the math there. So a 25% loss would bring me down to $750. I'd have to make $250 back to get it back. That loss on a $750 account is 33%. Okay? Now you can see why I went with 25%. It's because that's kind of the balance point before things start to really take off, and it takes way too much to get back a loss. Let's do another example. Let's say you had it 40% is what you allowed. That would mean if you lost 40, you'd be left with 600. Now you say, okay, well I've got to make $400 back divided by 600, and that's a 67 if we round that. That's a 67% return. Isn't that, I mean, look how important, this is crazy important right here. Okay, all we did was increased our risk from 25 to 40, only 15%. And it didn't just take 15% more risk. We took a lot more risk. You didn't even realize it. We took a 34% larger risk. More than twice as much risk is what we got out of that by just bumping it up 15%. And that's because it pushes along this curve. Now you're over here. And look how dangerous it gets if you get over here where you're risking 80%, it's going to take you 500% to get back an 80% loss. So this is really important stuff here, and like I say, 25 is going to be the max, and you could be risking a lot less than that, but you want to be in this side of that curve. As soon as you step over here, things really open up, and you're asking for a lot of trouble. Okay, so let's move on now. We've got that figured out. We're going to say 25 is our max, but let's say we decide to go with 10. Okay, so we're going to use 10% overall risk on our account. What that means is I don't want to see an overall drawdown of more than $100. And what you need to keep in mind here, this doesn't mean I can allow that in a day or a week. This is like 6 months. I do not ever want to see my account exceed that, is what we're basically saying. Or if it does, it should just be slightly more. Okay, so with that in mind, we want to give it a good 6 months. You know, let's just say 200 days. 200 days is what we're saying. We're going to measure for the drawdown. We'll just write this all right there, okay? So over 200 days. We don't want to see more than a 10% drawdown. So now what we can do to try to figure out how much to risk per trade, we need to figure out things like how many trades per day we're going to be making. So say if I'm a day trader, I'm just going to say I average 5 trades a day. If I average 5 trades per day, I now need to figure out, okay, if I were to go through a drawdown over the next 6 months, how many trades would be in that drawdown? Let me draw this, and hopefully this can make some sense, because you guys are going to want to do this little simulation. Once you've done it once, you're good. You don't have to figure it out again. You might make little adjustments over time, but overall, you have a pretty good idea of what you should be risking per trade. Okay, so let's say your trading goes something like this. This is your equity curve kind of growing. Okay, here's one of those drawdowns. Let's say from this point here to this point here, this was we call the peak and valley of your equity curve. Okay, because here we're about to head back up. And this drawdown period, we're just saying this is the whole 6 months here, this whole window. We found this was the biggest drawdown period we would have had. And what we want to do is figure out about how many trades is between there. And so, you know, maybe this lasted let's say it lasted about a month. Let's say this was a whole month before I pulled out of this. Okay, well at a month, if I'm averaging 5 trades a day, there's about 20 trading days a month. That's about 100 trades. So if I've got to allow for 100 trades to be in that drawdown period, then what we can look at is we can say, okay, well, we know we're not going to lose every one of those trades. We're not going to lose all 100 of them. So what we might do is divide that by, might cut that in half. You might even just take your risk to reward ratio, or not your risk to reward, your winning percentage, and figure this out. But I'm just going to say half to make this easy. So we can plan for about 50 trades of drawdown before we would hit our max. So that's a pretty good buffer, and like I say, you might adjust this over time, but the more room you give yourself, the better, and then later adjust it. So let's say we allow for 50. Let me clear this off here. Okay, so we're going to allow 50 trades in 200 days for drawdown. Okay, now what we can do is we can say, okay, I've got this figured out, got an idea now of how many trades are going to be in that drawdown that are really going to pull me down. So now I can take my risk percentage, which we're saying is 10, and I can divide that by the number of trades, 50. So 10 divided by 50. You can get your little calculator out. And oops. Use the math, it's 0.2 is how much you can risk as a percent per trade. So I can risk 0.2% per trade. Do you see how that works? It's a little confusing at first, and a lot of it doesn't have to be perfect. This could easily have been changed up. If I change this, it doesn't make a huge effect. The key is just don't. A lot of you are probably calculating 10 times the amount of this. Like I say, a lot of traders are trading 2%. And if I did that, according to this, that's way too aggressive. I'd be getting myself in margin call trouble and way over leveraging my account. So with this type of setup, day trading at 5 trades a day, based on a potential drawdown, I'm allowing about 50 trades and about 10 straight days of drawdown if I were to lose every single trade, which we know that's very unlikely, but you want to plan for that. I can do 0.2% per trade. Okay. Now this could change, like I say, if you're looking at swing trading, you might need to go out further than 200 days, position trading, and you might find this number goes up a bit, might even go up higher than 2%, like I mentioned earlier. So let's go with this example for now. Now that we know we can risk 0.2% per trade, we can then figure out our lot size by determining our stop loss. And like I mentioned, you can find the link on the blog post to try out PipStat. PipStat will do all this for you. It figures out your ideal stop and figures out your lot size based on your risk percent per trade that you set. But I'm going to show you how to do it here as well. Okay, so what you're going to do is need to figure out how much dollars this is in risk. So you're going to say 0.2% of $1,000. Okay, so we're going to go, you go 0.2, divided by 100 to get it into a percent, and then you're going to take that and take 1,000 times that. Okay, so we're going to go, first we have to take 0.2 divided by 100. Now we're going to times that by our balance. And that tells me I can risk $2 per trade. Okay, I can risk $2 per trade. Much less than you probably would think. That's because you're not thinking long term. You're thinking short term, I'm not going to have drawdowns, so it's not a big deal. But when it does happen, you get hurt bad. So this stuff's very important. Okay. You know, this can go up. I'm saying 10%. Maybe I'm going to go aggressive and go 25. You know, now that I have this all figured out, it's easy to do the math. Right here, I would just replace that with 25, and I'd be at 0.5% risk per trade. Really easy once you've done this once. Okay, I got $2 risk per trade. Now how do I figure out my lot size? I need to know my stop loss. So let's say I come up with a 40 pip stop. You know, make sure your strategy is determining that, not that, okay, you're saying I want to risk $100, I'm going to go trade a mini lot. That's not what you do to figure out your lot size. That's backwards. The right way to do it is figure out your risk first, then figure out your stop based on your strategy to get your lot size. Just like we're doing here. So a 40 pip stop loss, now that I've got that number, all I have to do is take $2 divided by 40. That's going to tell me how much per pip I can risk. I can risk 5 cents per pip. That's how much I can risk per pip on my trade. So now I just have to determine what to type in for my lot size when I go to take that trade, and I have it. Then I'll have everything figured out, everything I need for my trade. And we know that I've got everything planned out ahead of time, that I'm not going to get myself in margin call trouble and things like that, and putting up too much risk. So to figure out, okay, what's the lot size? Well, that depends on the currencies. If you've got euro dollar, we've got a 101 webinar about this part, so if you guys want more information, you can watch that, one of those replays. But anything with dollar based on the end is going to be, that's going to be $1 per mini, which is 0.1 lots on a regular account. They have accounts called nano accounts. What they do is they convert your accounts into a cent, so they'll actually multiply your balance by 100. So then when you trade 0.1, it's actually 100 times smaller. And that's how you'll be able to trade these smaller lot sizes to get you to be able to trade down to 5 cents per pip or less. Maybe you'll even be trading less than a cent per pip in some cases. You know, if your balance was $100, you'd be at a half a cent per pip. So you'd have to have an account that allows that. Don't try to trade a mini account or a micro account if they don't offer the lot size small enough that you need, as small as you need. Okay, so let me show you now. If you have something like the USD US franc, or if you have euro, pound, you need to convert this into dollars, the pip value into dollars, based on the cross pair here. So if it's pound, you got to get GBP USD rate. Let's say it's 1.56, and that's going to be your pip value because you got pound dollar. That's your pip value now. It's the pound currency rate in dollars. So that's going to be $1.56 per mini. Now for the US franc, it's a little more confusing. You have to take the reciprocal of the rate. The reason why is because it's franc here, and you say, okay, I need to get franc dollar. Well, there's no franc dollar like there is pound dollar. So franc dollar, the way you have to do it is take the US franc rate, and you take 1 divided by that. So we'll just say the US franc rate's 9,500. So that's going to be roughly 1.05. It's not like you just add it to the other side. It's a little different than that. So if you want to get your calculator out, go 1 divided by 0.95. See, it's 1.0526, which we'll just round it down. It is 1.05. But make sure you're doing the calculation there so you can see this. So that's going to be how that works. Like I say, we have a better, more detailed explanation on how all the currency pair calculations work in our 101 webinars. But that's basically how you do it. So let's just keep this one simple. Let's say you trade the pound dollar. It's $1 per mini at 0.1 lots. Well, we need to trade 5 cents per pip. How do we do that? Well, we need to start to reduce this. So we can say, okay, to get it down to a penny per pip, that's going to need to be 0.01. Oops. 0.01 lots. And like I say, that's not going to be possible with most brokerages unless you've got a nano account. Or this is actually a micro. Oops, not micro. This is a nano. Micro is going to be 0.01 lots, 10 cents per pip. And so like I say, what they'll usually do is multiply your balance, so you'll actually trade like 0.1 in this case, and it'll still just be a penny per pip. But make sure you're checking this out first. Check with your brokerage. Tell them you need to risk a penny per pip, or really 5 cents per pip, and you need to make sure your account's set up to do that. So now that you know that, it's very simple. You're going to trade 5 nanolots. So you're going to trade 0.005 of a standard lot. Okay. Now this takes some time to go through and do it all. That's why I say you probably want to check out PipStat. We have a trial offer. If you go to our blog, TradeWestForex.com/blog, you can see the post about these top 3 trading mistakes. You'll see the PipStat link in there. And that way you don't have to try to do this math every time you go to take a trade. But what you'll still have to do first, and you only have to do it once, like I said, is calculate this part. Figure out how much overall risk you want to have. Figure out your number of trades per day. Figure out how many trades you probably should allow in that window based on your strategy, your win rate, things like that. And then you'll know your risk percent per trade. Okay, well, that's a lot of stuff we've covered, but this part is a very important part of your trading, and it can make a huge effect. I've always liked money management because it's something that I can program into a tool that can tell you exactly what to do. It's all cut and dry. Where the emotion part of your trading, the searching that you guys are doing, I don't really have a lot of control over that. I can tell you guys, don't keep looking for some great system. You have plenty of great systems already, most likely. You just need to give them a fair try, apply some of these other things I've taught today, and you'd be much better off. Same thing with your emotions. I can give you some tips and suggestions and rules, but it really comes down to each trader, how they manage their emotions when they're trading. Whereas with money management, I can give you a tool that does all the work for you in calculations, and as long as you're implementing it, that part's getting taken care of. So we're going to go ahead and wrap this one up. I really hope you guys can take what we've taught today and start to apply it in your trading and start seeing some differences. I know that a lot of stuff seems really simple. A lot of you are going to look at it as, I've heard this all before and none of it works. But I'm telling you that it's probably not working because you're not giving it a fair chance. You're still looking for something short term. And that's natural, and it takes some effort to overcome, to be able to look at things long term and to properly manage all these things that we've covered. But once you do, you'll be far better off. So I know you'll see tremendous improvements in your trading if you follow some of what I've taught today. Okay, so we'll let you know. I'll get the next article written up this week, and the webinar will be Friday for the next one. And once again, thanks for coming in today, and hope you have a great